Hi, good afternoon. You're watching this edition of Closing Trades. It's not really turning out to be the best of afternoons. It's been quite savage. The fall, which began in the markets on Monday, you had a trading off on Tuesday, and then again that's resumed yesterday as well as today. In fact, it's gotten extremely brittle today. Of course, it's the global weakness which is also weighing heavy on our markets. But the fact that we've dropped below the 19,000 mark, not just that, we've even breached 18,900 intraday today, and we are lying, sub that mark as we speak right now. 19,786 is where we're currently at. And not just that, the breadth of the market as well has gotten extremely damaged. Look at the kind of market breadth that you're sitting on. You've got a count of 173 to the declines, with just 15 names standing to the greens within the F&O universe. The India VIX also has shot up quite a fair bit. You're seeing a jump up of over 8% on the India VIX right now. And the sell-off is largely led by the rate sensitives, realty banks. They are the ones which are really taking it on the chin. Having said that, the only respite, if you will, is that we're not alone in this weakness. Year to date, month to date, even week to date, the global markets have fallen much more than our markets. Maybe this week the picture could be a little bit different because Tuesday they were trading, we were on a trading holiday, and they did see a respite coming in. But even right now as I speak, Europe is a sea of red all across, about a 1% to about a 1.5% cut coming in across the board for European markets. Asia has plunged quite a fair bit. It was an over 2% fall coming in for the Japanese Nikkei. That's equating to about a 668-point fall on the Nikkei. Similar was the picture for Korea as well, which fell almost 3%. Shanghai and Hong Kong, of course, were a different trajectory altogether. Even as I look at the pre-market rates for US markets, and especially this is, in continuation with the weakness that you had overnight on US equities, still down over 100 points for Dow futures, 0.6% for S&P futures, and a good 1%, equating to a 150-point fall for the Nasdaq futures. So it seems like the global markets or US equities are headed in for another day of a fall. The only silver lining, I guess, is that it's steep, and the cycle perhaps of the fall may be shorter this time, as has been the case in the past.
Definition of a bull market is you don't have to worry about the small corrections which come in. And in my book, this is, I think, a smaller correction, more like a seasonal correction. The feature of any bull market correction is that it'll be very savage, it'll be very sharp. Before you actually realize that the correction has hit you, the correction actually will get over. And let's look at some stocks here. I'm not saying that the worst is behind us, but just look at the intraday graph of, let's say, Suzlon, intraday graph of BSC, intraday graph of Atul Auto. Just some stocks where the market, IndusInd Bank. Now let's look at Suzlon. From the intraday low, which was at 30 rupees, it's a recovery. It's a sizable recovery. Similarly, thrown in MCX. Another performing stock has been BSE, Bombay Stock Exchange. Interweave there you go, MCX, look at the recovery. 2162 has become 20225. BSE, 1600 has become 1800 right again. These are 30-40% recovery from the day's low. So from yesterday's close, first the fall, and from the fall, the recovery in some of these stocks is just telling you that everything in the market is just not getting washed out. That's part one of the story. Part two of the story is that definitely there is evidence of some semblance coming back into banks, whether it is HDFC Bank or whether it is IndusInd Bank or whether it is State Bank of India. So that's another ledge which is not looking bad at all. Could banking really lead the rally? So Aisha, if globally things settle down, then I think we're nearing the end of the decline. But if globally things remain slightly sticky, I think then the selling may just extend itself for next couple of days. I think before Diwali, I expect that the market should stabilize, purely looking at how compressed the selling is. Aisha, there was a time when even we've reported that market would follow a cycle, a 3-year bear market followed by a 2-year sideways and a 3-year bull market. Now it's months and days because of the speed, velocity, action, reaction, everything is so compressed and so quick that whatever adjustments have to happen, they happen in a matter of some 7-8 days. Look at the carnage and look at the recovery in some of the stocks I mentioned.
Yeah, absolutely. For now, we're staring at a good 278-point fall in the Nifty futures. In fact, let's take it across to our experts as well and figure out what they're making of the market right now. We've got Rajesh Palvia joining in on the show, Jay Thakkar too on the technicals, and Sandeep Sabharwal on the fundamentals. Jay, hi, afternoon. If I could just, kickstart the discussion with you. 19K breached, 18,900 as well breached. Where do we, or rather, how much do we fall next, and where do you see the next support coming in?
Hi, very good afternoon to you, Aisha and Nikunj. Well, see, as far as the current downtrend is concerned, of course, on the immediate basis, it looks quite oversold, and there can be some bounce back. But then that bounce back will be short-lived, is what I believe, because the medium-term trend seems to have reversed, Aisha, clearly, because the monthly indicators are likely to go into the sell mode with this. Next week when we have the monthly close, most of these monthly indicators are likely to close negative, and that would in fact trigger more selling pressure going forward. And one interesting thing, Aisha, which I would like to point out is that Bank Nifty has broken down from a clear double top pattern, which is a bearish reversal pattern. So we had that range of 2,500 points on Bank Nifty, which has got broken on the lower side below the levels of 43,500. So the next target below those levels comes to 41,000 to 40,000. That's the outlook for Bank Nifty in the medium term. So that would definitely add some pressure on Nifty as well going forward, and hence Nifty can correct until the levels of 18,550.
Sandeep, hi, afternoon. Are we just aligning ourselves with the rest of the globe, given the outperformance we've had in the past?
Yes, I think reasons for the corrections come later, but I think the view was that there should be some sort of correction after the euphoric up move, especially in the small and mid cap side, because when that kind of euphoria comes in and the kind of crazy valuations which IPOs were getting or are still getting, I think that's not good for the market. So I think that's the phenomena which is playing out. That said, my view was that since Nifty and the Sensex moved up around 20%, so there should be a 10% kind of give up, because I don't see it going more than that. So I think now we are maybe 300-400 points away from that in terms of the Nifty. So that's what I think should be the worst case. I don't see it going below that. So in that context, after 3-4 months, this is now the time when markets are giving opportunities to buy, and people should start, whoever has cash should start allocating now and allocate till the end of November. That's my view. From December, market should be okay.
Let's get that list going. Sandeep, you almost axed your foot there. What is it that's looking ripe after the recent correction?
See, if we correlate how the results have come out with what's happened in the markets, the banks, the larger private sector banks seem to be better placed, especially ICICI and Axis. So I would think that those would be at the top of the heap for people looking to allocate on the large cap side. Reliance has had a good correction, so that could possibly look decent. Auto stocks still look good, although they have not corrected so much. And L&T has given up decent gains from the top, so that's something which can be looked at from the large cap side of the market.
Sure. Rajesh, hi, afternoon. Is it time to buy the fear already?
Yeah, good afternoon. So still we will wait to buy aggressively at this juncture. Let the rollover activity to happen, and then we will review what kind of rollover data is taking place. Till now, yes, Nifty is in oversold zone. Bank Nifty is now slipped below to 200-day moving average. So Bank Nifty is looking one notch weaker compared to Nifty, but Nifty might give some pullback action from here. 18,850 is the level where we are keeping eye. If we able to hold this level, then some pullback we can see, but not a big pullback. It could be around up to 19,000. That's the level where again it's a steep resistance for the market. At this moment, we are focusing on two stock, one on the long side, one on the short side. From long side, Puravankara is looking attractive. In corrective move, almost stock has taken the support from its 20-day moving average, and now again we have seen again buying action in the stock, and the stock is showing recovery sign. Overall structure is bullish. Stock has formed a series of higher top, higher bottom formation. So overall, we believe that Puravankara can show some uptick from the current level, and I think one can buy this stock for upside target of 155. one can keep a stop loss of 133. On the short side, Piramal Enterprises is looking weak. Now stock has given a breakdown of 100-day moving average, and looking at the rollover rate data that is on the short side, and we expect that furthermore follow-up selling we can see in Piramal Enterprise. So on the downside, we are projecting a target of 915 for November future. So one can take short bet in Piramal Enterprise with stop loss of 964. Downside target is 915.
Sandeep, if you're of the view that it's a matter of, this is like a stumble, this is not even a pause, what gives you this confidence? Because if I look at the sum total of numbers, with the exception of banks, Sandeep, we've not had any big upgrade, any big beat, any company which has really spoken great things about the earnings outlook. So if the earnings are just about in line with estimates, then where the trigger will come from?
See, Nikunj, only two big category of companies have reported. In terms of, if you look at the bigger categories, you look at banks, financials, and IT. So IT has been more or less a whitewash. And that was expected. So there are many people who are still bullish on IT, but I think 2024 could be even worse than 2023. So that's one big segment of the market I'm not looking at. But financials, I think, have done very well. On the auto side also, there have not been much results, but Bajaj Auto results were very encouraging. And I think across the board, we'll see decent results from auto. Many other companies might not have reported good results, but that's also due to a shift of the festival season from this quarter to the last quarter to the current ongoing quarter this time. So many of the durable, etc. companies will see more growth this year. Now, from the Indian context, I believe we do not have issues related to fiscal deficit. Inflation is reasonably well controlled. Current account deficit issues are not there. Rupee is stable. And the growth outlook is pretty decent. So I think there are parameters. On the macro side, I believe India is very well placed. And in that context, these sort of corrections will come, but there will be opportunities to invest.
You got a 1.3% cut on the Nifty and 250 points down on the Nifty. Jaitakar, for somebody who's looking at Nifty, the news is that we've had a breakdown and a market which was flat has now become oversold. So are we nearing the end of the pain, or whatever we will see in the near term could just be a technical bounce and the way is actually down rather than up?
Right, Nikunj. Yes, overall, I would say the trend has reversed from up to down. And in the short term, as you rightly said, things look a little bit oversold. Of course, if you look at the derivatives data as well, I mean, out there, the PCR is looking quite oversold, and there can be some good technical bounce back. But yes, that technical bounce back should be sold into. I think that would be a temporary bounce or a dead cat bounce, I would say. And once that gets over, we'll again see the downtrend resuming. So whatever bounce we see from this oversold territory, whenever it comes to say maybe 19,000, 19,200 range, that is a good range to again go short on markets, because I believe that on the upside in the short term, 19,500 is a very clear resistance, and which is almost 600 points away from now. So on the short side, the risk reward is not that suitable right now, because we are targeting say 18,500 to 550, which is 300 points away, 350 points away. So that risk reward is not matching right now, is not favorable right now. But yes, if at all there is a bounce in the range of 19,000 to 19,200, there it will offer a good risk reward to go short again.
The small cap index, hello, has recovered 3% from today's low. So a crack and the recovery. Now let's look at some stocks here. The ticker team will fire it. Recovery in Suzlon from the day's low. Recovery in MCX from the day's low. Recovery in Bombay Stock Exchange from the day's low. That's BSE. We are used to saying BSE, so it's actually Bombay Stock Exchange. Suzlon has recovered about 4-5% from the day's low. BSE has recovered 13% from the day's low. MCX has recovered also quite smartly from the day's low. So recovery has actually started kicking in. Recovery has started kicking in very, very smartly from the day's low. Sandeep, it's always NSE who's called as the big dada of Indian stock market. But the real price performance this year actually has happened in Bombay Stock Exchange. In a matter of days, the stock has gone up by about 3x. Do you think this is just hot air or something fundamentally has changed in BSE? Your smile tells me that वहाँ change नहीं हुआ है.
No, see, NSE is not listed, so the only stock you can play is BSE only. So that's why it's gone up. If NSE was listed, it would also have gone up. Now the point is that, see, in a duopoly, ultimately both players should ideally be doing well. And it's a matter of time when one catches up vis-a-vis the other. And that's what is playing out in many companies where competition is limited. So BSE, so these companies have secure market shares, reasonable profit, not too much to invest. So these are kind of stocks. So BSE was neglected because people thought that everything NSE is doing right. Then eventually people realized that even BSE is doing some things right and they'll also be much more profitable. And that's led to this re-rating. Now, whether it will keep on going up like this, I think unlikely, because now the valuations seem to be extended. But longer term, it should still do okay.
Good to have you on the show. We'll let you go on that note. Glad that you could take time out and speak with us as always. Here's an exclusive bit of news now coming in on Jio Financial. In fact, Somit is here to tell us what he's picking up on this one. Somit?
So what we understand from our sources is that Jio Financial's promoter, that is the Mukesh Ambani family group, has bought another 2 crore shares in Jio Financial from the open market. So yesterday around 1 crore shares of buying was done by the family group, and today another 1 crore have been bought from the open market by the promoter group. Now, the promoter had an aim to increase their shareholding in Jio Financial by around 2.5 crore shares, and of this already 2 crore shares have been bought from the open market, which means that another 50 lakh shares can be bought by the promoter group going forward. Now, since listing, if you see, the promoters have increased their shareholding in Jio Financial by around 0.97%, and post the current tranche, the promoter holding in Jio Financial will increase by another 0.5% to close to 47.2%. Another interesting fact that we have noticed here is that when we first reported this news was in August 29th, and at that time Jio Financial share prices were trading around to 206, 207 levels, and that time we had seen some promoter buying coming in, and in the last couple of days again the share prices were in the range of around 206, 207, and again promoter have bought another 2 crore shares from the open market in Jio Financials.
Big breaking news right here on ET Now. Sources have told ET Now that Jio Financials, the promoter group, they've increased their stake, and the promoter have committed additional capital of about 200 crore, which means that they've done open market purchases of nearly 1 crore shares. Since listing, the promoters have increased their stake by 1%. Post the current tranche, the promoter holding could be, according to our calculations, anywhere between 47 to 47.2. Of course, Reliance Industries, when we reached out to them, they did not respond to ET Now query. This is not confirmed. This is something which we learned from sources. And we had also reported a similar story where promoter had increased their stake when the stock had fallen below 210, 215 a couple of weeks ago. Let me also bring on board Rajesh Kothari to take our conversation forward. Rajesh, the narrative for last 2 or 3 months was small cap stocks are expensive, mid cap stocks are expensive, lock some gains, they're becoming stretched. But in last 2 days, just 2 days of correction, and chins are down, everybody's feeling depressed. When everybody wanted a correction or that correction is coming, we should be welcoming it.
Absolutely. I think you narrated it very well, yeah. So these markets are always like that. Everybody asks for correction, and then when correction comes, all of a sudden people think a little bit, disappointed and at times frustrated. So I think corrections are part of market, and I'm sure, I think by now the investors are also getting more and more evolved in last 4.5, 5 years, where the cycles are getting shorter. So use this correction as an opportunity. I think undoubtedly we are in a structural bull market. Corrections are part of market. Look at 2003 to 2008. That time Sensex went up 5 times in 5 years. But there were 6 episodes during that period when market corrected by 20%. I mean, the Sensex corrected by 20%. The mid and small cap, of course, would have corrected much more. So we can't skip, those periods. There is no gain without some pain, So I think we are in that journey, and some correction is always good.
I think sanity is important. The numbers, fundamentals are important. There are many stocks which actually went up without fundamentals. Surely, I think they are going to definitely come down to where it belongs to, where it's supposed to be. And at the same time, there are many companies where fundamentals are strong, but the valuations have moved up. Now they are coming at probably at a comfortable zone. So I think over next 2, 3, 4, 5 months is going to be good time to do kind of a staggered way of investing in mid and small cap. That's actually what we are suggesting to our investors.
215 rupees for Jio Financial. So Rajesh, what's been your investment strategy? Where are you shopping on every decline, or where you're shopping irrespective of a decline, no decline?
I think there are a few pockets where the growth is going to be very strong for next 2 to 3 years. And one such space is going to be auto ancillary space. The content per vehicle is going to be a significantly larger size compared to what it used to be in last 10 years. Second important is the electrification of the vehicle. That is also going a significant change. And third, of course, from ICE to EV. So there are many companies who have been supplying, say, 500 rupees per vehicle. Their size of opportunity will become, 2,000 to 5,000 rupees per vehicle. So I think this is going to be a very, very interesting space. The valuations are still quite reasonable. The many companies in auto ancillaries have very decent return on capital employed, upwards of 18 to 20% plus. And over 3 years, there are many companies which can deliver almost kind of, I would say, 20, 30% compounded annualized growth for next 3 years or so. So it's a good space to be in. It has nothing to do with the, I would say, change in any political regime or the risk of geopolitical or risk of the elections, state election and central election. By and large, they are less impacted from such events. So I think this is a one, sector which we are looking very closely. The second sector, what we continue to like is capital goods. Again, a lot of investments are already happening. The PLI efforts by government is definitely helping a lot. The capacity utilization has finally started to inch up. And last but not least, a lot of productivity related investments are also happening in this sector. So this is the second space which we like, that's capital goods. And third, very selectively, one is to look at the consumer space. This is a space, many of these companies have not done much in last 2.5, 3 years. There is a good amount of time correction in this consumer space. And as the discretionary spend starts going up, as the inflation little bit comes down, the rural power also comes back. And of course, we need to remember that this is an election year. MSPs of wheat has already revised upwards, probably highest in last 3-4 years. So the rural income is going to do superbly well from December quarter onwards.
Sure.
So I think that will give another boost to the consumer sector in general. So I think this is a third space where one need to be stock specific and identify the good opportunities where again the growth can be significantly higher than the underlying Nifty growth.
Sure. Rajesh, stay with us. Lots more to talk about the sectors that you highlighted which are looking attractive. For now, we're going to take a very quick break. We're still sub the 18,900 print and still down about 278 points. We'll track the markets on the other side.
Well, it's very easy to make a case why banks should be part of everyone's portfolio. The problem is that when everybody is making the same case, they say that all the good news is in the price. Is that the case for banks? Because I'm yet to find a bear on HDFC Bank. I'm yet to find a bear on ICICI Bank. Yet to find a bear even in PSU banks now.
To be bullish or bearish is a function of two important things. One is particularly in banks. So one is of course what is going to be your earnings growth, correct? Second is the underlying ROE. Is it improving or not? And third, very important, is what valuations you are paying it. And I think this remains true for any company in any sector. And in case of banking and finance, the growth is good, ROE is healthy, and valuations of a few private sector banks probably are trading at last 5 years low. In few cases, it is last 10 years low. So, therefore, it becomes a natural preference for any good long-term manager to look into this case. It is a strong investment case, undoubtedly. The one thing which is, at times, what we need to pay attention to is what is the digital prowess of these companies to keep gaining the market share. Because we should keep in mind that today it is no more private versus PSU. The PSU banks have also grown handsomely in last 2.5, 3 years, just like their peer group private sector. And therefore, whether that valuation premium, what private sector used to command, and the valuation discount which PSU used to get from market, to what extent they both are justified, and at what level probably the premium or discount will narrow. That's each fund manager's call. But banking and finance in general definitely will deserve a good allocation by any good manager. At our firm, what we are doing, we are having a blend. So we are having a blend of private sector banks, PSU banks, few select NBFCs, and also few select what I would say new small finance banks, where probably growth is going to be much higher. The ROA is improving, and the valuations are at a significant discount. They are treated actually just like compared to like PSU banks, almost something very similar to that. So big discount compared to the big boys of the sector, and therefore we see a good runway of both growth as well as the valuation re-rating.
Okay, great to have you on the show, Rajesh. Thanks so much for taking the time out and joining in. Here's also another word coming in. Nikunj had a special interaction with Sameer Arora as well as Dinsha Irani of Helios, and they told us about some tips to beat the market and get more returns on a longer term basis.
We are saying that equity markets in the long run do well, but how to do better than that equity market is by you being ready to change if needed or to add if needed. But there is no need when the market is liquid, when the market is visible, that I must today take a 20-year bet. I will take a 3-year bet, and if it is continue to do well, I may add or I may walk away. But since a large number of companies do well in the medium term, but the same companies don't do well again and again, that's why you see in the long term, private sector banks, really only 2 banks have created wealth. HDFC Bank, Kotak Bank.
वो भी underperform कर रहे हैं.
अब वो आजकल, but also over time. But if you had started in 98 or 97, there were at least 5 other banks, Times Bank and पता नहीं कौन, GTB, Global Trust Bank and Centurion Bank, Bank of Punjab, वो तो चलो फिर, Bank of Punjab, all of them went to zero. But on that day, you can't say I'm buying long term this, you're buying it in multiples of 1 to 3.
You don't see something like this anywhere in the market. If you have to treasure hunt, shake some trees. Can you find this kind of a theme which could be a powerful theme in next 5-10 years?
No, it could be, but I'm saying you don't know which of those fellows will be the winner.
Of course.
So
let's
therefore
talk a theme. See, financials cannot be that theme. It's a discovered theme, right? Consumption, that's the India romance.
ऐसे नहीं होता. If you see, if I broadly define consumption, everything will be consumption. You might say now it's shoes, now running shoes, now it is food delivery. Ultimately, it's all.
What is that mega trend according to you?
I will tell you very simply. In 1 month, our full disclosure of 100% of the portfolio will be there.
Of course.
तो पहले आप फंड में डालेंगे, then only.
और वो 90 days में इन्वेस्ट करोगे ना, 1 महीने में नहीं होगा.
हम तो 1-2 महीने में ट्राई करेंगे करने की. So we won't wait 90 days.
All right, now let's also bring on board Rahul Sharma to understand the market mood and the technicals. Rahul, gone below 19,000, gone below and staying at 18,850. What is the relevance of that?
Yeah, so clearly the markets are heavily oversold as we are almost done with the monthly expiry. And the major indicators that we track, on one side you have the put call ratio, which is below 0.7. heavily oversold. Then you have the Nifty daily RSI, which is below 30, again very oversold. And you also have something, which probably will be confirmed by today's data, is the rollover stats. So the rollovers do turn out to be on the lesser side, which is the bears getting an exit in this fall and, making merry and booking profits. That would call for a breather, and we should see a slow gradual recovery happening in the Nifty from here on. So my sense is, it's a very high possibility that, today is one of those days where we hit the bottom and, we see, a slow gradual recovery going ahead from here. So at 18,800, 18,900, the risk reward is very favorable for longs. if you are a positional trader, if you are looking to get into quality stocks, these are the corrections that ideally one should look for. For this view to go wrong, or as an exit, I would keep 18,500 as a stop loss. And I think if you take like a 3-month horizon, there is a very good possibility that the entire thing gets reversed, and we are on track to hit a new lifetime high for the Nifty. So from a positional macro technical perspective, I think we are overdone, and we should see a bit of a relief, especially given after today's monthly expiry.
Stocks here, guys. You got BSE, you've got APAR, if you've got MCX, we've got Shilpa Medicare. I think this is for me the real highlight of the day, that stocks where momentum has been exceptionally strong, they're popping right back up. So one day of selling, second day of carnage, not even second day actually, we sold off I think on Monday, then we saw carnage on Wednesday, and today half a day. So actually 2.5 days of real gut-wrenching selling, and then you actually crawling back. Richard Harris joins us now. Let's understand, and let's hear his views on where he feels the geopolitical tension is moving and what he makes of the current spike in global volatility. Mr. Harris, really good afternoon to you. Thank you for joining us. Do you think in the near term we should fasten our seatbelts for more bad news, more volatility, and more risk-off scenario?
Well, I think we've actually had a reasonably good run of things over the last, pretty well. So yes, we are seeing some risk off at the moment. We are seeing prices coming back, but we're also seeing equities still reasonably strong, buoyed up on a lot of liquidity, and the fact that earnings are coming in quite well and the consumer still seems quite strong. So there are mixed messages out there, and different narratives are coming to the fore. My general feeling is that we're not going to see a crisis anytime soon unless we see a change in the current events.
What should one do, Mr. Harris? Use the uncertainty to your advantage and add more stocks, or right now it's time to keep the gunpowder dry?
Well, it depends where people are. Personally, I'd probably keep my gunpowder dry, but if you're low in stocks, it might be a buying opportunity. But if you've got a lot, it might also be a selling opportunity. Generally, at the moment, I'd be light on bonds. But I still favor equities in the very short term because we do have the fact that the market does seem to be adapting to bad news as it comes along, because there's also good news out there. If you think about it, the markets have generally survived both Ukraine and Israel, and they're going to need quite a significant extra shock for them really to come off sharply.
Richard, that's the other thing. I mean, how long is the weakness going to persist? Because going by the Fed commentary last time, super hawkish, even if they don't act on rate hikes, we already know it's going to be higher for longer, and the yield and the spike thereof is already going to ensure tighter liquidity conditions. So are we looking at the risk-off trade extending for some more time to come?
Well, the Fed put interest rates up in order to slow economies down. So we shouldn't be surprised that money supply is shrinking and that there's interest rates are going up, and that's likely to slow economies down. That's why they put them up in the first place. The Fed is very reactive, but I think at the moment they've probably got it about right. If you look at 5% interest rates on the long bond, at least on the 10-year, we have to admit that's not particularly high. I mean, money shouldn't be free, and it's basically been free for the last 3, 4, 5 years. What we're looking at now, I think, actually is the old normal becoming the new normal, because we're in a situation, if you look at the US, for instance, where you've got low unemployment, you've got pretty well 3% inflation, you've got 2 to 3% growth, you've got 5% interest rates. Now that, economically, over time, has been a Goldilocks scenario.
All right, Mr. Harris, really appreciate your time. So glad you could join us. We've got a nice steady recovery in the mid and small cap stocks. It's not bad, and it's looking quite, heartwarming to see that. We're in conversation with our experts. Let's cut our window just to showcase that we've got a full powerhouse. We're discussing Nifty technicals. We're also discussing, where things are moving in terms of the market Nifty. Rajesh, can you independently just analyze the small cap index for us, because it's seen a mighty recovery of about 3% from the day's low?
mid-cap both have recovered from the day's lows, and I think the recovery is taking lead in this two space, and we believe that if Nifty stabilize at a certain point, Nifty small cap, mid cap index both can show good recovery, because the fall was very major fall was there in last two trading session, and I think 50% kind of recovery we can see in coming trading sessions. So let the Nifty to stable at certain point, and looking at the data setup, we believe that post this rollover, Nifty will also try to find out some support buying activity at around 18,800, 850 zone. That's the important critical level where we are focusing at this moment. So I think Nifty small cap is the index where yes, we can see some recovery towards 12,600, 12,700 kind of level from the current level. So I think another 2-3% kind of up move we can see in coming trading session. And I think here is the focus. One should keep focus on Nifty small cap and mid cap stocks, where we see that leadership or recovery can be there faster compared to the large cap space this time.
Rajesh, what's your sense? You think the time has come to start nibbling into mid and small caps already, or would you say, keep your tilt towards large caps? They're safer right now.
So I think small cap and mid cap can be the area where one should focus at this moment, because most of the stocks in correction is still holding their short term, medium term moving averages. That clearly shows that still the liquidation process has not done for the mid cap, small cap. Still, investors are holding the position. So I think recovery will be faster in small cap, mid cap. So one should look at this space to play the pullback of market.
Stick it out with the mid and small caps. That's the word coming in from Rajesh. Rahul, what do you feel? Do you think it's going to get exaggerated before it arrests itself, the fall in mid and small caps?
Yeah, so we've enjoyed a multi-month rally in the mid and small cap space, and this week is actually a proper first breakdown that we've seen in the index. So my sense is the pain in the mid cap, small caps could continue. Yes, there could be selective outperformances here and there, but as a sector, I think the correction has just begun and probably get prolonged for a few more weeks. As far as opportunity, or as far as value, or better risk reward is concerned, it is a large caps which relatively look much better, especially after this correction. So we are completely focusing on the large cap space. In fact, our Diwali picks this year, all of them are from the large cap space. We are not even touching mid and small caps, even with a barge pole. That is a kind of move that we've seen in the last few months. So my sense is it's better to sort of look at areas of the market where the headroom is higher, and on a relative basis the risk also seems to be lower. So our bet is to go for large caps and let the mid and small cap correction play out completely.
Rahul, because what one has seen is that there is a clear distinction between some of the heavyweights, like say for instance a Reliance, HDFC Bank, Kotak Bank, which have been stark underperformers. The rally has been led by very different horses. When the market does recover, do you think there'll be a change in terms of what's going to lead the recovery, and would underperformers like a Reliance, HDFC Bank participate then in the recovery whenever it comes by?
Yeah, I think, rather than looking at the blue-eyed boys, it is better to focus on the stocks which have fallen less in this correction. So if you simply do a point-to-point analysis, in the last, few weeks, the Nifty correction, we've seen 2 or 3 areas of the market which have done relatively better. So the top ones that come to my mind is, one is the auto space, second is reality, third is public sector enterprises, and lastly, we have PSU banks. So these are, the 4 key areas which have fallen less in a correction, which has been, both broad and wide in terms of price and time correction. So my reading is, these relative setups where, the weakness has not been there are the ones which will be the first ones to bounce back. So from the reality space, one can look at DLF, from a macro structure, the setup is still very bullish. From the auto space, something like a Mahindra and Mahindra, Tata Motors look pretty solid. From the PSU banking pack, Canara Bank is something that we like particularly. In fact, today, PSU index has actually seen a very sharp recovery from the lows in the private banks, which has been dragging the banking index down. And overall, the best thing is always to buy into strength. So we are sticking to strength, and once the markets reverse, this is where we are expecting the maximum upside in terms of momentum and price as well.
Okay, let's try and analyze what the carnage has been like amid all the weak global cues as well, concerns about the run-up in the broader markets. Where is the sell-off evident and where is the recovery? What's been dragging the markets lower? Samit and Vinny join in for further insight. Samit, you go first.
Well, if you see in the last 5 days, the carnage has been much more in the broader market. Nifty has fallen just 3.5%, but mid-cap and small-cap index have declined anywhere between 4.5 to 5% in the last 5 trading days. Now, what are the levels that they're trading at? Nifty 50 is trading at its lowest level since June 38, and it's also below its 50 and 100 DMA, while Nifty mid-cap and Nifty small-cap indices both are below their 50 DMA, and Nifty mid-cap is trading at its lowest level since August 25th, while Nifty small-cap is at its lowest level since September 1st. On the RSI front, if you see, Nifty 50 and Nifty Midcap are trading at 32 level, and do remember that 30 is the oversold zone, so they are most likely at their oversold zone, while Nifty Small Cap RSI stands at close to 41 times. And do remember that the RSI levels for all the three indices are at its lowest from March 2023 till now. Now, if you see the constituents, nearly 76% of the constituents are trading above the 200 DMA for Nifty 50. This number was close to 94% a few days back. For Nifty Midcap, it's around 80% currently. A few days back, the number was close to 96%. And when it comes to the Nifty Small Cap Index, it's currently at 78%. A few days back, the number was close to 91%. Now, sector-wise, if you see in Nifty 50 in the last 5 days, only 2 stocks have managed to gain, that is Nestle and Bajaj Auto, with gains of around 4%. On the loser side, it's Wipro, UPL, Adani Enterprises, NTPC and Divi's Lab, which have lost anywhere between 6 to 7%. When it comes to mid-cap, only 5 stocks have managed to gain: Prestige Estates, Persistent, Ipca Labs, United Breweries and Tata Elxsi, while on the loser side, 4 are PSU companies: IGL, Bank of India, Mazgaon Dock, BHEL, and the 5th one is Biocon, which has dropped close to 12%. And lastly, in Nifty Small Cap, 9 stocks have declined: BSC, Angel One, Suzlon, Credit Access, Grameen, Welspun India. These are actually the gainers. In fact, 9 stocks have gained. And on the loser side, 3 out of 5 are PSU companies: NMDC Steel, Hudco and MRPL, while the other 2 are HFCL and Zensatech. But Vinny, apart from the 3 main indices, I assume the fall has been much wider when it comes to the broader market, right?
Absolutely, the fall has been much wider as well. And look at just the valuations first. Let's just look at that as well, right? When you look at the current valuation for the Nifty versus the 5-year average or the 3-year average also, when you compare it, look at the Nifty, 18.2 times is the current valuation 12-month forward versus the 3-year average is at 19.7. So clearly that fall has come in terms of valuation for Nifty mid-cap, small-cap, also similar trend, and a sharper fall that has come in the Nifty mid-cap. Small-cap is almost at the similar levels when you compare a 12-year forward with a 3-year average as well. Now, other than that, in the last 5 days, it is always, when you look at the broader markets and the broader stock overall, out of the 5,686 stocks that are listed in India, 61% of the stocks have seen a decline. So you look at the amount of stocks also, clearly a sharp decline we're seeing coming in the broader base as well. Now, in terms of just sector-wise as well, Nifty PSU Bank, sharp fall that has come in the last 5 days, 6.7% decline. Even when you look at the metal space, the realty space, that has seen a sharp fall as well. And it's across the markets that we are seeing a fall coming in. The least fall that we saw coming in was in Nifty Auto, that was 1.9% to 2%. But yes, clear fall that we've seen coming in across the sectors as well. Other than that, it's not only India, global markets too have performed weak. When you look at it in the markets in Philippines, that was down by around 4%, Korea was down by 3.9%, China too down, and India's 3.4%. So clearly that range has been coming in even in the global markets of around 2% to 4% fall that we've seen coming in across the global markets. Weakness is continuing everywhere else, and that is the pressure that is coming in on India as well. So overall, also we are seeing a fall coming in this time.
Right. Okay, both of you, thanks for analyzing the market construct. In fact, we have Anand Tandon as well joining in on the show right now. Anand, hi, afternoon. Sorry to keep you waiting. Just wanted to understand what's the message out there. Buy the fall just yet? Wait for the dust to settle down? What do you do in this market?
Well, if you're a trader, I think the market is somewhat oversold at this stage, and therefore it would be you could start getting back in a little bit in the anticipation that over the next week or so you would see a bottom being made in the near term. However, as an investor, I think unless you find something where the valuation is compelling, I think it's early days yet. I don't think we are done as far as the global interest rate cycle is concerned, and that will finally translate into changes in India as well. I think the biggest elephant in the room, which nobody wants to talk about, and I'm talking economics, not geopolitics, is simply the outstanding amount of debt. We are at $300 trillion debt world with a $100 trillion economy for the whole world. And that simply is not going to go away with every major economy still increasing their debt because of the deficit that they are running. So we are running into tough times going forward, and I think a major correction is due, but perhaps not just yet.
I get your point. So, Anand, what is it that we're looking at? Because while India has managed to stay resilient up until this week, of course, amidst the global fall, and global markets have done worse than us, how much more of a fall do you anticipate? And when would it come by?
Well, neither of the two questions is something that is possible to answer, at least if you're not looking at the charts. So the only way one can deal with it is, one, make sure that you are reasonably diversified in terms of your asset allocation. But more importantly, stick to an entry point which you are comfortable with, in stocks you are comfortable with. At this stage, I would not recommend going into illiquid stocks, especially those which are very small in terms of market cap. A, most of the valuations are much higher. And two, it's extremely difficult to exit if you have to. So you have to be a trader, you should be trading, which is buying stocks which you can get in and out, which essentially means you're looking at large cap. Within the large cap universe, look for those which have fallen probably the most in the near term, which have reasonable institutional investments, and that would be a good place to start. I would argue that the ones that have performed the weakest, for example, the HDFCs and the ICICI of the world in the recent times, are more likely to be longer-term strategic bets and make better earnings over the next 4 or 5 years than perhaps trying to be too smart in terms of trying to pick unknown stocks.
Sure. In fact, let's pick up on that point as well with our experts. Rahul, what do you anticipate for the market? Does it seem like the fall is going to end anytime soon? And I don't know if you really track what's happening on the US bond yields or the charts for US equity markets and NASDAQ or a Dow. What's the sense that you're getting about when the global fall is going to arrest?
Yeah, definitely. So, a few days back, it was the US markets which were heavily oversold, but the flow of negative news just kept on coming. First, the Israel war, then we saw the spike in crude oil prices, and then the bond yields. I think, having said that, if these numbers do retrace or pull back, we should see a breather. We should see a relief rally happening as far as the Nifty is concerned. But I think it's better to be take the bottom-up approach, which is not look at what the broader markets are doing until the global scenario settles down. And once that is in place, I think it will be a relatively better position to be in. So, like I said, it's better to have a bottom-up approach along with look at sectors and stocks which are exhibiting strength even in a downfall. So I think as a strategy that has played out well for us in the last few weeks. And, looking at today's correction, it definitely seems like if rollovers do happen on the lower side, which is what we are expecting to, we should see some bit of resurrection happening in tomorrow's session and going ahead. So November, as of now, it's more, advisable to be hopeful than fearful because, most of the negative news at this point in time are factored into the prices. And if there is lack of any further negative evidence, we would, very well see the shorts pulling the trigger and probably today they have also got a hard landing that they were looking for.
We're pretty much closing in.